Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to talk about why I believe Taiwan Semiconductor Manufacturing Company or TSMC stock is one of the best AI semiconductor stocks that is likely undervalued now. As you may already know, TSMC stock has been down a lot in recent weeks. There are several major reasons. First, the market has been having a very large market rotation in recent weeks because many investors and fund managers have been rotating their investments from the mega cap growth stocks to more small caps and other companies that have not rallied much this year. The US inflation has slowed down a lot in recent months. As a result, the US Fed is expected to start decreasing its interest rate starting in September this year. Of course, this will benefit small cap stocks the most, at least for the short term. Many mega cap tech stocks, AI stocks, and semiconductor stocks have rallied a lot this year, so many investors have been selling the mega cap tech stocks to capture their gains. The second reason is this. Trump recently commented that Taiwan should pay the US for defense. Trump said that Taiwan has been taking 100% of America's chip business. Also, the Biden administration is considering having the highest trade restrictions on chip-making tools that are being exported to China. Of course, all these geopolitical issues and chip export restrictions always affect semiconductor companies including TSMC, ASML, Applied Materials, NVDA, AMD, and Intel the most. So in this video, I'm going to explain why I believe TSMC is one of the best AI semiconductor stocks that's likely undervalued now. You will learn about these topics in this video. First, I will give you a very quick stock portfolio update. Then I will talk about TSMC's biggest risks to consider, TSMC versus Intel's process node technologies, TSMC's financials and long-term growth prospects, TSMC stock valuation, and whether I will buy TSMC stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. I talked about this earlier. At the time of making this video, the market has been going through a large market rotation because investors have been selling off the mega cap stocks and rotating to more small caps and other stocks that have not rallied much this year. This is why you can see the Nasdaq 100 QQQ ETF has been down a lot recently. Personally, I'm not too worried about this large market rotation. The main reason is this. In the short run, the market is a voting machine, but in the long run, the market is a weighing machine. This means business fundamentals and earnings growth matter the most in the long run. The market is more rational in the long run. The market will eventually rotate back to the mega cap tech stocks once they see that they're oversold or they're undervalued. More importantly, the mega cap companies such as Apple, Microsoft, NVIDIA, Google, Amazon, Meta, TSMC, and Broadcom have the strongest fundamentals, the largest economic moats, and the most competitive products and services in their industries. They are the market leaders in their industries. Many of them are near monopolies. They earn the most profits and free cash flows each year. They are also benefiting the most from the current AI boom. This is why I expect that all these mega cap tech companies as a group will eventually recover and perform very well over the long run. So I'm not worried about the current market rotation. In my opinion, this market rotation is giving us more opportunities to buy the dip. Now I want to show you one of my portfolios here to show you my investing strategy over time. This portfolio is separated into 3 different accounts. This is the first account. It's still performing very well even during the current market rotation. You can see that I have invested in Microsoft, MasterCard, Visa, Amazon, TSMC, Google, ASML, and Meta. I will continue buying more TSMC and ASML over time whenever they're undervalued. They are monopolies in their markets. I believe they will continue to benefit the most from the current AI boom. This is the second account. This account is also performing very well, even during the current market rotation. I have been rebalancing this account recently to make it more concentrated on the best businesses. My main investing strategy is to keep buying and holding the best wide mode businesses that are undervalued. You can see that I have invested in Apple, Google, Microsoft, Visa, TSMC, American Express, NVDA, and Amazon. All of these businesses are very profitable. I don't invest in companies that are not profitable yet. All of them have very large economic moats and great long-term prospects. It's nearly impossible for competitors to compete with them. This is the third account. This is a much newer account than the other two accounts, so it will take longer for many of these companies to become multi-bagger stocks. This account has been down a lot recently, mainly because of the current market rotation. I'm not worried about it because these companies' business fundamentals have not changed at all. More importantly, I have invested in many outstanding businesses including Microsoft, MasterCard, TSMC, NVIDIA, Amazon, Google, Synopsys, ServiceNow, Adobe, Meta, Visa, Salesforce, and Broadcom. They are the market leaders in their industries. Over the longer term, I expect all of them will recover and become multi-bagger stocks because of their strong fundamentals, large economic moats, increasing earnings, and increasing free cash flows over time. Now, going back to TSMC, what are the biggest risks we should consider? Let's talk about the obvious. Semiconductor companies are always affected by geopolitical issues and trade restrictions the most. This applies to every major semiconductor company including TSMC, ASML, Applied Materials, NVIDIA, AMD, and Intel. TSMC is not the only semiconductor company that's affected by geopolitical issues and chip restrictions. For example, TSMC is not allowed to manufacture the most advanced semiconductor chips such as the high-end AI GPUs for China. But TSMC can still manufacture the much less powerful chips for Chinese customers, so just not the high-end chips. Recently, most chip stocks have been down a lot because of Trump's comments about Taiwan. He said that Taiwan doesn't give us anything. Taiwan took about 100% of America's chip business, and Taiwan should pay the US for defense. I believe the market is just overreacting to Trump's comments. This is another noise or fear, uncertainty, and doubt created by the market. The Biden administration is considering imposing the highest restrictions on chip-making tools that are sold to China. The US is trying to prevent China from buying the most advanced chip-making tools from ASML, Applied Materials, NAND Research, and other semiconductor companies because of national security concerns. The US does not want China to have access to the most advanced chip technologies and AI that could be used for surveillance and military. Here's the deal. These chip export restrictions are not new at all. They will continue to be there for many years. The US wants to be the leader in AI and chip-making technologies instead of China. That's why the US is restricting China from buying the most advanced chip-making tools from ASML, Applied Materials, and NAND Research, and from buying the most advanced AI GPUs from NVIDIA, AMD, and Intel. But if we step back to look at these geopolitical issues, we have to understand that the US is only restricting China from accessing the most advanced chip-making tools and chip technologies. China is the largest exporter of electronic devices, mobile devices, Internet of Things devices, computer devices, machinery, vehicles, and many other electronic products. The US needs China to continue exporting these products that do not require the most advanced chip technologies. This means the US will not prevent TSMC from making lower performance chips for Chinese customers. Here's the biggest risk to consider. This is another fear, uncertainty, and doubt or FUD created by the market. Many investors and analysts are concerned that China may one day invade Taiwan. Of course, if this happens, this will affect TSMC the most because TSMC's most important fabs are all in Taiwan. To mitigate all these geopolitical risks, TSMC will continue expanding overseas, especially in the US. For example, TSMC will continue expanding its fabs in Arizona. Once Arizona's fabs become online, they will be able to produce 4nm and 3nm chips for US customers. But TSMC will still keep its most important fabs that have the most advanced chip-making technologies, leading-edge process nodes, and advanced packaging technologies in Taiwan. Let me explain why I believe China will not invade Taiwan. There are several main reasons. First, if China invades Taiwan, China will have access to TSMC's most advanced fabs, EUV lithography systems, and other very advanced chipmaking technologies. This means China will automatically become the chipmaking leader in the world. Of course, the US will not allow this to happen because the US does not want China to become the chipmaking leader and the AI leader. The US wants to be the leader in AI and chipmaking technologies instead. I believe the US will do everything it can, such as selling more arms to Taiwan or imposing additional trade restrictions on China to prevent China from invading Taiwan, even though Taiwan does not have a formal defense treaty with the US. Second, TSMC is too important for everyone. TSMC is the largest and most advanced chip foundry in the world. To put it simply, TSMC is the most mission-critical chip foundry in the world. TSMC manufactures around 90% of the most leading-edge chips in the world. All the major chip designers such as Apple, NVDA, AMD, Qualcomm, Broadcom, and MediaTek rely on TSMC to make their most advanced chips. Even Intel uses TSMC to manufacture some of its chips. If China invades Taiwan, which I believe will not happen, it will disrupt the entire global semiconductor market. It will cause a global supply chain crisis. This will impact all the major US tech companies that sell semiconductor devices, smartphones, tablets, personal computers, CPUs, GPUs, AI systems, AI server equipment, and much more. All the major US tech companies such as Apple, NVIDIA, AMD, Qualcomm, Broadcom, and even Intel will be greatly impacted if something happens to TSMC. Also, both the US economy and the Chinese economy will be greatly impacted if something happens to Taiwan and TSMC because the most important fabs are all in Taiwan. Here's the important thing we should consider. It's nearly impossible for companies to switch to another chip foundry such as Samsung foundry if something happens to TSMC because TSMC has the most advanced chip making technologies and the most chip manufacturing capacities in the world compared to Samsung foundry, Global Foundries, and Intel foundry. For example, according to Counterpoint Research, TSMC has dominated the global chip foundry market for many years. At the time of making this video, TSMC has around 60% of the global chip foundry market. More importantly, TSMC makes around 90% of the leading-edge chips in the world. Samsung Foundry is the second largest foundry in the world. Intel Foundry is far behind TSMC and Samsung Foundry. TSMC is too important for everyone, especially the US tech companies such as Apple, NVIDIA, AMD, Qualcomm, and Broadcom. This is why I believe the US will not allow China to invade Taiwan and disrupt TSMC's foundry business. This is the third reason. If you have been following China's economy in recent years, you will know that the Chinese economy is not doing well at all compared to the US. China's real estate market is still in a huge downturn. China's economic growth has slowed down a lot in recent years. The unemployment rate is high, especially among the younger workers. Consumers have slowed down their spending a lot in recent years. Local governments have too much debt, and prices have been decreasing in recent years. This is why China has been cutting interest rates to increase economic growth and consumer spending. Here's the important part. Based on what I know, China wants much better economic growth and chip sovereignty. China does not want to start a global crisis, such as invading Taiwan, that would disrupt their entire economy. Invading Taiwan would greatly impact the Chinese economy. TSMC is the most important chip foundry in the world. If anything happens to TSMC, it will impact everyone and cause a global chip crisis. Of course, the US will not allow this worst case scenario to happen. Let's talk about TSMC versus Intel's process node technologies. Intel is TSMC's biggest competitor in the US. Many investors believe that Intel will be able to catch up to TSMC's process node technologies by the end of 2025. I'm going to argue that this is not going to happen at all. Intel CEO Pat Gelsinger said many times that Intel is on track to achieve 5 process nodes in 4 years. In the most recent Intel Foundry event, Intel CEO Pat Gelsinger even stated that Intel is now back to process node leadership. This is completely misleading to investors. Let me explain more here. If you look at Intel's current roadmap, you can see that Intel seems to be on track to achieve 5 process nodes in 4 years. Intel stated that its most advanced 18A process node will be manufacturing ready in the second half of 2024. Here's the important part you should know. All these process nodes, Intel 7, Intel 4, Intel 3, Intel 28, and Intel 18A are just marketing names. These process node names no longer represent the actual transistor density, size, and features they used to represent before. You can correct me if I'm wrong, but based on my research, Intel 3 is equivalent to TSMC's N5 process, and Intel's upcoming 28 and 18A process nodes are equivalent to TSMC's N3 process in terms of power, performance, and area, or PPA. Here's the important part you should know. TSMC already started mass producing chips for Apple based on its N3 process or 3nm process back in Q4 2022. This is around 2 years ahead of Intel. Also, Intel stated that its 28 process is manufacturing ready in the first half of 2024, and its 18A process will be manufacturing ready in the second half of 2024. This means Intel has not achieved high-volume manufacturing for these advanced process nodes yet. Typically, it should take Intel at least 1 more year to mass manufacture chips based on these new process nodes 28 and 18A. This is why Intel is at least 1 or 2 years behind TSMC in mass manufacturing chips based on the most advanced process nodes. Intel CEO Pat Gelsinger claiming that Intel has gotten back to process node leadership is completely misleading to investors. Here's another example that shows Intel will still be well behind TSMC even when Intel releases its 18A process. TSMC CEO expects that TSMC's upcoming N3 process node will beat Intel 18A in 2025. He said, TSMC's internal analysis has shown that its N3P process is comparable with Intel's 18A node in power, performance, density, and size, despite the size difference. At the same time, he noted that TSMC will maintain technological superiority despite Intel offering backside power delivery at 18A due to its N3P node being earlier to market, more mature, and at a lower cost. According to Anitech, TSMC's N3P process will enter high-volume manufacturing in the second half of 2024. This is at least 1 year ahead of Intel's 18A. I said this earlier, Intel's 18A process is expected to be manufacturing ready in the second half of 2024. This assumes Intel will not delay again. So by the time Intel's 18A process enters high-volume production, let's say in 2025, TSMC's even more advanced N2 process will already enter high-volume production in the second half of 2025. Here's another sign that shows that Intel is still well behind TSMC in process node technologies and in mass manufacturing of leading-edge chips. This process roadmap seems to suggest that Intel is on track to achieve 5 nodes in 4 years. Not only that, Intel is aiming to have an even more advanced 14A process node in 2027. Here's the tricky part many investors don't know about. All these process node timelines are Intel's risk production timelines. They are not high-volume manufacturing timelines. Intel will need to add at least 1 year to these timelines to show when these new process nodes will likely enter high-volume production. So I would not trust Intel when they say that they have gotten back to chip leadership again. Here's the deal. Intel has fallen well behind TSMC and Samsung Foundry in recent years, mainly because of many product delays, execution issues, chip manufacturing issues, and even chip design issues. Intel competes with all the major chip designers such as Apple, NVDA, AMD, Qualcomm, Broadcom, and ARM Holdings. It will not make sense for the largest chip designers to share their IPs and chip designs with Intel and outsource chip manufacturing to Intel. On the other hand, TSMC does not compete with its customers. TSMC has the most advanced chip-making technologies, the most advanced process nodes, the biggest cost advantage, and the most capacity compared to Samsung Foundry and Intel Foundry. Also, TSMC has a much better track record in mass producing leading-edge chips for customers such as Apple, NVIDIA, AMD, and Qualcomm. This is why I believe the largest tech companies will continue to outsource chip manufacturing to TSMC going forward. However, if TSMC does not have the capacity, then customers will outsource chip manufacturing to Samsung Foundry and Intel Foundry. Let's talk about TSMC's most recent financials and long-term growth prospects. TSMC reports its earnings mostly in Taiwan dollars, so all these financials are in Taiwan dollars. But here you can see that TSMC has had very consistent revenue growth and operating income growth over the past 10 years. TSMC also has been growing its free cash flow gradually over the past 10 years. If you compare TSMC's operating margin and free cash flow margin with Intel and other chip foundries, you will notice that TSMC operating margin and free cash flow margin are much higher than competitors. Let's look at this consensus revenue forecast. Over the next 3 years, TSMC's total revenue is expected to grow between 15% and 30% each year, and its earnings per share is expected to grow at similar growth rates. I believe these growth rates are reasonable because TSMC will benefit the most from the current AI boom and the very large demand for high-performance computing HPC going forward. At the time of making this video, TSMC has a very strong balance sheet. In fact, TSMC has around 63 billion in cash equivalents and marketable securities. In comparison, TSMC has around 30 billion in short-term and long-term debt. This means TSMC can pay off all its debt in advance and still have around 33 billion in cash left. TSMC is much more profitable than Intel, global foundries, and other chip foundries. For example, in the most recent Q2 quarter, TSMC's gross margin was 53%. Its operating margin was 42.5%. The chip foundry business is extremely capital intensive. Typically, most chip foundries have much lower gross and operating margins than TSMC. Most chip foundries' revenue and operating growth are not as stable and consistent as TSMC. Next quarter, TSMC expects that its gross margin will be between 53.5% and 55.5%, and its operating margin will be between 42.5% and 44.5%. Over the longer term, TSMC expects that the company's long-term growth margin will be 53% or higher. In terms of revenue by technology, TSMC's advanced process nodes, including N7, N5, and N3 nodes, contributed about 67% of the company's total value in the most recent Q2 quarter. Here is the important part you should know. TSMC's process node technology will continue to be TSMC's biggest competitive advantage and growth driver for many years. TSMC will continue to earn higher revenues from these most advanced process nodes because there's always a very large demand for them. TSMC's biggest customers, Apple, NVDA, AMD, Qualcomm, Broadcom, and other major chip designers, all want to use these latest process nodes because these leading-edge nodes can greatly improve the power efficiency, performance, and area of chips. TSMC's next-gen N2 process node is expected to enter high-volume manufacturing in the second half of 2025. After that, the A16 process node is expected to start volume production in the second half of 2026. This means TSMC will start earning revenues from these even more advanced process nodes starting in 2025 or 2026. Based on what NVIDIA, AMD, and other major chip designers all want to move to the N2 process and A16 process as soon as possible because they are looking for ways to develop AI chips that are much more power efficient. NVIDIA's current AI GPU H100 and its next-gen Blackwell AI systems use a lot of power, and they often need liquid cooling. Power is one of the biggest limiting factors in AI data centers. These new process nodes N2 and A16 will make AI chips more power efficient going forward. In terms of revenue by platform, TSMC's two most important platforms are high-performance computing, HPC, and smartphone. High-performance computing, or HPC, will continue to be TSMC's biggest growth driver over the next several years because there's an enormous demand for generative AI applications and the most advanced AI accelerators that are needed to train AI models. AMD, Broadcom, Amazon, Google, Microsoft, and Tesla are all making their own AI accelerators because they don't want to rely entirely on NVIDIA. All of them still need to use TSMC to manufacture their AI chips. This is a huge competitive advantage for TSMC. At the time of making this video, the smartphone market is slowly recovering. Going forward, most iPhones and Android phones will become AI smartphones. The upcoming iPhones and Android phones will need to have NPUs and AI processors that are powerful enough to run AI models locally. Of course, Apple and Qualcomm will continue to outsource chip manufacturing to TSMC. I want to share this article with you. According to the Wall Street Journal, TSMC expects that its full-year value will grow slightly above mid-20% or slightly above 25%, up from previous low to mid-20% range. Of course, the biggest growth driver is TSMC's high-performance computing HPC business. TSMC CEO said this, "The demand is so high, I had to work very hard to meet customer demand." TSMC expects that its high-performance computing (HPC) demand will continue to be very high, at least throughout 2024 and 2025, mainly because of the very large demand for AI chips that are used in data centers. TSMC's management said this in the most recent earnings call. It shows TSMC's biggest competitive advantage, its leading-edge nodes, and the enormous demand for AI chips that will last until at least 2025. Finally, I'll talk about our N2 status and A16 introduction. Our 2nm and A16 technologies lead the industry in addressing the insatiable need for energy-efficient computing, and almost all the AI innovators are working with TSMC. We expect the number of the new tape-outs for 2nm technologies in its first 2 years to be higher than both 3nm and 5nm in the first 2 years. N2 will deliver full node performance and power benefit with 10% to 15% speed improvement at the same power, or 25% to 30% power improvement at the same speed, and more than 15% chip density increase as compared with the N3E. N2 technology development is progressing well, with device performance and yield on track or ahead of plan. N2 is on track for volume production in 2025 with a ramp profile similar to N3. We also introduced A16 as our next nanosheet-based technology, featuring Super Power Rail or SPR as a separate offering. A16 is best suited for specific high-performance computing HPC products with complex signal roads and dense power delivery network. Volume production is scheduled for the second half of 2026. We believe N2, N2P, A16, and its derivative will further extend our technology leadership position and enable TSMC to capture the growth opportunities way into the future. Here's the important part that shows the enormous demand for TSMC's HPC platform and TSMC's chip-on-wafer-on-substrate CoWoS advanced packaging that's needed to package AI chips, SoC, and HBM memory together. TSMC management even stated that the company's chip-on-wafer-on-substrate CoWoS advanced packaging capacity continues to be very tight all the way throughout 2025 or even later. Management said, I also try to reach the supply and demand balance, but I cannot today. The demand is so high. I have to work very hard to meet my customers' demand. We continue to increase, and I hope sometime in 2025 or 2026, I can reach the balance. You're talking about the CAGR or those kind of increase of the chip-on-wafer-on-substrate CoWoS capacity. Now it's out of my mind. We continue to increase whenever I can. The supply continues to be very tight all the way through probably 2025, and I hope it can be eased in 2026. That's today's situation. All the people want to move into kind of a power efficient node, and so they're looking for more advanced technology so that they can save power consumption. And so a lot of my customers want to move into N2, N2P, and A16 quickly. We're working very hard to build the capacity to support them. Today is a little bit tight, and not a little bit, actually, today is very tight. I hope in next year or the next 2 years, we can build enough capacity to support this kind of demand. Today, yes, we're working hard to support them. I want to show you this consensus revenue forecast from Seeking Alpha. TSMC's revenue is expected to grow by around 24% in 2024 and in 2025. After that, TSMC's revenue is expected to slow down starting in 2026. In terms of EPS forecast, TSMC's EPS is expected to grow around 26% in 2024 and around 27% in 2025. After that, TSMC's EPS growth is expected to slow down. In terms of valuation, TSMC's forward PE is expected to be around 25 this year. This is very low compared to Intel and other semiconductor companies. Next year, TSMC's forward PE is expected to drop to around 20. This is exceptionally low compared to NVDA, AMD, and Intel's forward PEs. This is why I believe TSMC is undervalued now. I want to show you this intrinsic valuation model here. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate TSMC's intrinsic value, so you will know when TSMC stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define TSMC's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe TSMC's revenue will grow between 22.5% and 27.5% this year. After that, I believe TSMC's revenue will slow down to around 15% each year. This is the base case scenario. I used a long-term growth rate of 9% to calculate the terminal value. Typically, the overall semiconductor market, excluding memory, grows around 10% each year. This is why I think a long-term growth rate of 9% is very reasonable. If you want to be more conservative, you can use a lower long-term growth rate here. I'm using a 19% free cash flow margin here. This is consistent with TSMC's free cash flow margin over the past 10 years. Let's go over these three case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that TSMC's revenue will grow by around 22.5% this year. After that, we're forecasting that TSMC's revenue will slow down to around 12.5% each year over the next several years. Then TSMC's intrinsic value should be around $979 billion for the entire company, or $189 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that TSMC's revenue will grow by around 25% this year. After that, we're forecasting that TSMC's revenue will slow down to around 15% each year over the next several years. Then TSMC's intrinsic value should be around $1 trillion for the entire company, or $209 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that TSMC's revenue will grow by around 27.5% this year. After that, we're forecasting that TSMC's revenue will slow down to around 17.5% each year over the next several years. Then TSMC's intrinsic value should be as much as $1.2 trillion for the entire company, or $231 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, TSMC's intrinsic value should be around $209 per share. I also used a forward sales valuation model to estimate TSMC's intrinsic value, which should be around $768 billion for the entire company, or around $148 per share. If we take the average of both valuation models here, I believe TSMC's intrinsic value should be around $179 per share. This is in US dollars and not in Taiwan dollars. Just to compare, Morningstar has given TSMC a much higher fair value of $213 per share. This means I believe TSMC is undervalued now. The 40Ps I showed you earlier also suggest that TSMC is likely undervalued now. So will I buy TSMC stock? My answer is yes. I will continue buying TSMC over time whenever it's undervalued. There are several reasons. First, I like TSMC's business model and its near monopoly in the global chip foundry market. TSMC makes around 90% of the leading-edge chips in the world. It's the most important pure-play chip foundry in the world. All the major chip designers such as Apple, NVDA, AMD, Broadcom, Qualcomm, and even Intel need TSMC to manufacture the most advanced chips. Second, like NVIDIA, TSMC is benefiting the most from the current AI boom. If I have to make an educated guess, I believe we're still at the beginning of the current AI revolution. More large companies around the world will continue to invest in AI infrastructures and AI services, which will benefit TSMC's high-performance computing HPC business the most going forward. And third, TSMC will continue expanding its fabs in the US. This will reduce some of its geopolitical risk. Based on what I know, China wants economic growth and chip sovereignty, but China does not want to start a global chip crisis such as invading Taiwan because it will disrupt its entire economy. TSMC is the most important chip foundry in the world. If anything happens to the company, it will impact all the major companies such as Apple, NVIDIA, AMD, and even Intel, and cause a global chip crisis. Of course, the US will not allow this to happen. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.